All right, let's just jump right into this one. Welcome back to The Explainer, where today we're unpacking a really fascinating and frankly pretty unexpected value investing opportunity over in the Chinese consumer market. Look, when most people glance at China right now, all they see is economic turbulence. But as we're going to see today, for the disciplined value investor, that kind of turbulence often obscures some absolutely incredible mispricing. So we're going to break down the mechanics of YUM China and look at why this might just be the ultimate contrarian play right now.
Keep this single number in your head for a second, 0.63. That is Morningstar's price-to-fair value ratio for YUM China. Simply put, for every dollar of intrinsic value this company holds, the market is only asking you to pay 63 cents. We are basically anchoring our entire analysis today on this heavily discounted asset. The market is clearly pricing in a tremendous amount of pessimism, but we really need to ask, does the actual data support all that fear?
So here's our roadmap for today. We'll start with the macroeconomic context, then look at the value opportunity, move into their expansion in minor markets, and finally, wrap up with efficiency and future margins.
Okay, part one, the macroeconomic context, navigating the headwinds.
Look, if you've got some skepticism and fear about the current state of the Chinese economy, that is completely valid. You've read the headlines, and obviously the broader market shares those exact same anxieties. These heavily publicized macroeconomic problems are very real. We're looking at a persistent real estate downturn, a pretty notable lack of aggressive economic stimulus from the government, and because of all that, you've got suppressed consumer spending. It is undeniably a tough environment for restaurants right now. People are tightening their belts, and discretionary spending is taking a real hit. Honestly, if you just stopped your analysis right there, you'd probably just walk away.
But here is the crucial point. It's all about how a company actually survives and even thrives in this kind of environment. In a sluggish economy, having massive scale and a really healthy balance sheet, well, that becomes your ultimate defensive tool. When times get tough, it's the value-oriented players who win. Because YUM China has such immense scale and just a fortress of a balance sheet, they can actually afford to be super aggressive on pricing when their competitors simply can't. They can literally lean right into the downturn, offer incredible value to strapped consumers, and effectively starve out smaller competitors.
Moving on to part two, the value opportunity, a massive runway for consolidation.
So let's pivot away from those broad macro fears for a second and just zoom in on the raw market opportunity, because this is where the contrarian thesis really starts to take shape. Check out this extreme fragmentation. In China, independent, mom-and-pop restaurants make up a whopping 80% of the market. Chain restaurants capture only about 20% of consumer spending right now. And during an economic downturn, it's exactly those independent restaurants, the ones without the fortress balance sheets or the deep supply chain advantages, that are getting squeezed the hardest.
To really put that 20% into perspective, let's compare it. When you juxtapose China's 20% chain market share with, say, the 60% market share that chains hold in the US, or even just the 35% global average, the picture becomes incredibly clear. There is a massive, multi-decade runway here for industry consolidation. And who benefits the most when a heavily fragmented market finally consolidates? The biggest, best capitalized player in the room, for sure.
Plus, despite all the current headwinds regarding real estate and stimulus, there are some really strong secular trends quietly working in the background. Long-term, the quick-service restaurant segment has pretty much guaranteed growth, and it's driven by three powerful social shifts in China right now. You've got an increasing number of office-based workers who just need quick meals, you have long-term rising disposable incomes, and you're seeing shrinking family sizes, which naturally leads to folks eating out or ordering in a lot more rather than cooking massive meals at home. So when you actually factor in their defensive strength along with these really solid secular tailwinds, Morningstar gives this stock a fair value estimate of $76 a share. And keep in mind, this isn't some pie-in-the-sky valuation. This comes with a medium uncertainty rating and a standard capital allocation rating. It's a very grounded, rational estimate showing that the stock is currently 37% undervalued.
Which brings us to part three, expansion in minor markets, penetrating lower-tier cities.
Okay, so we know the market is super fragmented, but how exactly is YUM China going out and capturing it? Well, the secret actually lies way outside the massive Tier 1 cities that usually dominate the financial news. First, we just have to establish their sheer dominance. As of 2025, YUM China is operating over 18,000 locations, pulling in a staggering $12 billion in system-wide sales. They are unequivocally the largest restaurant operator in China. And this immense scale, it's not just some vanity metric. It's the physical foundation, the massive logistics network that lets them execute their next phase of growth way cheaper and faster than anybody else could even attempt.
So their strategy basically breaks down into 3 distinct prongs, all targeting these smaller, untapped markets. First up, they are aggressively pushing KFC into thousands of lower-tier towns that currently have zero presence. Second, they're rolling out this new Pizza Wow format, which is a smaller, budget-friendly, takeout-oriented store into cities that already have a KFC but don't have a Pizza Hut yet. And finally, they are rapidly accelerating franchise expansion in highly protected locations. Think highway service areas and major transportation hubs, which lets them speed up their market entry without tying up massive amounts of their own capital.
All right, part 4, efficiency and future margins. The supply chain advantage.
Now, this directly answers the absolute biggest concern any value investor is going to have right now. If you're expanding so aggressively into these smaller, minor markets with budget-friendly formats, how on earth do you protect, let alone expand, your profit margins? Well, just take a look at their financial targets for 2026 through 2028. They are actively targeting mid to high single-digit compound annual growth in system sales, double-digit growth in net new stores, and crucially here, double-digit growth in free cash flow per share. Oh, and by the way, they plan to return 100% of that free cash flow right back to shareholders. It is just an incredibly strong forecast, and it completely flies in the face of the whole sluggish economy narrative. And they aren't just doing this with chicken and pizza. They're utilizing these massive structural advantages to win in adjacent categories too. Take coffee, for example. The macroeconomic slowdown has absolutely crushed some major brands. I mean, we've all seen Starbucks facing some really tough challenges in China lately. But Yum China has stepped in and perfectly positioned their Lavazza brand. It offers this differentiated premium coffee experience that is just quietly sweeping up the market share that struggling competitors are leaving on the table.
Morningstar senior analyst Ivan Su really hits the nail on the head here. He points out that the group's in-house supply chain acts as this immense economic moat. By structurally lowering food and logistics costs, they are able to drive immediate profitability, even in brand new, nascent concepts. I mean, Lavazza already achieved a 6% restaurant margin in the third quarter of 2025. So that aggressive expansion plan into minor markets we were just talking about, it runs on this exact same supply chain, meaning every single new store they open in a Tier 3 city is being supported by Tier 1 city efficiency. That is exactly how they structurally safeguard and sustain those future margins.
So at the end of the day, we really have to ask ourselves, does the real value hide in these minor markets? Because it kind of looks like all those macroeconomic fears dominating the headlines might just be creating the perfect smokescreen. For a true contrarian investor, someone willing to look past the surface-level anxiety and focus on incredible local market execution, a fortress balance sheet, and a margin-expanding supply chain, Yum China presents a seriously compelling case. I'll leave you to ponder that one. Thanks for joining me on this explainer, and remember, keep questioning the consensus.